Hello, and welcome back to another episode of IG's Trading the Markets podcast. Today, we're going to be focusing on the technology sector, which, as we all know, has recently been hardly hit in the markets. Joining me today for the episode is Anthony Ginsberg, manager of Tech Megatrends ETF. Anthony, welcome. To start off, can we get a brief insight into the setup of your ETF and why the tech sector?
Thanks, Daniela. Yes, our Tech Megatrend ETF has actually been around for over 3 years. It's equally weighted across 8 sub-themes. So we cover the broad tech space everywhere from cybersecurity and cloud technology to digital entertainment, robotics, AI, as well as electric vehicles and gene sequencing. And it's a global mandate. So it is an index benchmark product. We actually use Selective, the German experts on thematic indexing. And as I said, it's close to 120 holdings, and it's equally weighted across each of the holdings and each of the sub-themes. So we don't take a particular position on any one of these sub-themes, such as cyber versus cloud, but we have 8 of these sub-themes, and essentially you've got almost about a 15% weighting per sub-theme or thereabouts, just over between 12 to 15%. And we rebalance every 6 months, and the US weighting is at the moment about 59%. So it's very different to the NASDAQ, which would be much more overweight the FANGs and the top 7 or 8 tech players. We're considerably underweight because we're only equally weighting each holding at around a 1% weighting at this point.
Right. And I think it's impossible to talk about the tech sector right now without talking about what's been happening in the market, because we saw a lot of these tech companies benefited from, this drive towards digital transformation, especially in the workplace. And that led to a period of rapid growth. But we have seen that market slowing down, especially towards the end of 2021 and the beginning of this year. What do you think are the biggest challenges for the sector moving forward?
Well, it's a great question. Firstly, I know it's cold comfort, given that people who have invested have obviously seen a sizable reduction in their valuations. But we don't believe that the fundamentals are changing dramatically. In fact, we've seen a big pickup in IT expenditure across the board, both from corporates and governments when it comes to things like cloud and cybersecurity. The Pentagon is awarding a new $9 billion cloud contract later this year. We've got data showing that cloud expenditure is supposed to double within the next 2 to 2.5 years. And actually, total IT expenditure just on cloud and cyber is going to represent approximately 45% of all IT expenditure from next year or the year thereafter. This is according to Gartner research. So the fundamentals actually have not necessarily changed. We don't believe we're going back to pen and paper, as it were. I live in California, and I can say that the hybrid work from home is continuing at pace. In fact, many people are only coming into the office 2 or 3 days a week there. Younger demographic workers don't want to be coming in 5 days a week. So the usage of particularly cloud, cyber, but also things such as social media, which is another sub-theme. I've got kids who are teenagers. They're all using online gaming along with social media to connect to their own friends. And you hear screaming coming from their bedrooms because they're playing games online in a social space with 4 or 5 mates. So we don't actually see fundamentals changing in terms of people going away from this new digital entertainment. I will just say that online gaming is actually 5 times larger than the Hollywood box office. So even though my friends in Los Angeles like to talk about Hollywood all the time, actually the main part of digital entertainment for us is not so much Netflix. It's actually Activision, Blizzard, and other big online gamers. As you probably know, that Microsoft spent a fortune, about $75 billion, to go and buy the Activision gaming company recently. And there's a lot more big tech acquisitions and M&A activity that we see coming through the pipeline. And I'll just mention one other thing. The Ukrainian war has actually pumped up the demand for cybersecurity. We already had a lot of hack and Russian hack attacks in the last 2 years. We had the Colonial pipeline hack on one of the largest US oil pipelines. We also had something called Solar Winds, which was probably the Russians going after about 20 different units within the US federal government. So when you talk to CEOs in America, they will admit that cyber hacking is one of their top 3 or 4 priorities in terms of expenditure and focus areas. So we remain bullish fundamentally. Would also just mention, regardless of what's happened in the P earnings, actually were above or met expectations. So this is rather a more macro issue that's going on right now. There's been indiscriminate selling across the board, and the likes of Apple and Microsoft, which are massive cash cows and have tens of billions of dollars on their balance sheet, can in no way be compared to what happened back in 2000 or 2001, when you had the likes of pets.com and unsustainable tech businesses. I think we're in a very, very different era and a different space. So we remain fundamentally bullish, and actually think that there are going to be a lot of opportunities and bargains right now for new entrants into the market to invest now, and also to make acquisitions at much, much cheaper valuations. I mean, PE ratios, just very quickly on the tech area, have come down from the order of about 28.9 times earnings if you look at the S&P at tech space, to about 20 to 21 PE ratios now. So it's a lot more affordable. Anyway, that's just a long way of saying that we remain bullish fundamentally, that we're not going to go backwards in terms of tech not being utilized. It's still a fast track during COVID, and we believe the work from home trends are likely to continue.
But do you think strategic priorities have maybe changed, especially, for tech companies in this year and heading towards the future? Do you think they're still going to be looking for that rapid growth and that bargaining on, increased activity, or are they going to start focusing more on optimizing their current processes and consolidating their strategies?
Well, I'll divide it into two areas. The big tech players, obviously, they are limited in terms of the antitrust rules and monopolistic rules. They can't go and make, the likes of Google certainly can't make any acquisitions very easily in the search space, and Facebook, Meta, it was similar challenges in making acquisitions in social media. So what you're seeing is that they're increasingly diversifying, and we happen to also run, besides our tech megatrend ETF, we also have a cloud computing ETF, as well as a healthcare innovation ETF. And we've seen big tech moving into digital healthcare in a big way, into healthcare innovation, because in America we don't have a national healthcare service. And if you're in New York and you go and get sick in California, historically these patient records, medical records, were not digitized properly. So recently, Oracle, just as an example, as well as Microsoft, both spent close on $30 billion making acquisitions in the digital healthcare and patient and doctor record caring space. One was called Cerner, another one was called Nuance Communications. So the point there is that the tech boys are really moving into related areas. And again, I mentioned earlier Microsoft buying a huge bet on online gaming, which is somewhat related to social media as well. So we see a confluence of these various sub-themes. There's a convergence, essentially, where you've got cloud computing, cyber, overlapping, increasing, almost like first cousins. And then you've got the likes of social media and online gaming also engaging, particularly in places like Asia, by the way. Asia is the fastest growing space in cloud technology, but it's largely being pushed by streaming of gaming and video streaming as well. So our view actually is that the world has changed fundamentally during COVID, and we're not necessarily going to go back. But to answer your question directly, there's a reprioritization by some of the big tech firms to actually spread their business risks. And we just incidentally saw a couple of other very interesting things. Google bought a large cybersecurity player recently, which was something new for them. So I think we are saying we're expecting more M&A activity, not less, but it will not be necessarily in their home market. It may be in an allied market, such as I just referred to with the likes of Google, and even Netflix has actually bought a gaming business now. They want to offer not just Hollywood movies, but online gaming and downloads. So it's a very, very interesting area. It's very, very hard, Daniela, to time particular sub-themes. That's why for our tech megatrend, we equally weight and take profits every 6 months, essentially. So when blockchain last year was going gangbusters, that's one of our sub-themes, and we made a lot of money in blockchain a year or so ago. Obviously, this year has been very, very tough, but by rebalancing every 6 months, you can either lock in your profits in the good times, and we certainly aren't overweight any one particular theme.
Great. And let's talk now a little bit about another risk that,
Mm,
everyone's got fresh on their mind, and that is obviously inflation and how it presents a challenge for pretty much every
yes,
sector out there, but specifically the tech sector in terms of economic growth and what does this mean for their valuations. Now, there's a lot of concern as well about higher labor costs and energy costs and how this impacts the tech sector. What do you
yes.
think is the principal risk here for the industry, especially after seeing 2 years of very high growth, and we're now potentially faced with this period of uncertainty and potential economic recession? I mean, that's what central banks are talking about. Increased interest rates as well. That's hindering, the valuation of the tech sectors. What do you think is the big risk here, the big impact it's going to have on the performance of the sector?
It's a wonderful question. None of us are prophets. I would just say two caveats. One is that the Federal Reserve has lost considerable credibility over the last 6 to 12 months, as is the BOE here in the UK, in terms of being behind the curve. So there's been a sort of a slapdash effort. I think the markets actually don't necessarily trust that the central banks are getting ahead of the curve, and there has been this lack of credibility. And until the inflation numbers do come down below, in the US, below 8%, there is this nervousness that the markets just don't trust that the central banks have got their act together. So there's this bigger issue over there. I think the minute you start seeing inflation rates come below 7, 6, 5% levels, it will be good news for technology. The worst hit parts of the tech sector actually are the many smaller players who only have earnings well into the future. And sort of being an ex-Wall Street fellow myself, when you start discounting the cash flows, um, at higher interest rates, it's actually the biotech firms have been really hurt amongst the worst. Gene sequencing companies, these are companies that are actually only earning profits well into the future. So the smaller players whose profitability is really determined far into the future, when you discount their cash flows, they're the ones more severely uh, being hurt right now. And we actually think it's a bit indiscriminate, the selling, when you look at Apple and Microsoft being hurt recently, because they're actually big cash cows. They're generating sizable profits. I'll say one very important thing as an accountant, if I put my hat on for a moment. If you look at their business models, these big tech firms and even the mid caps that we also are largely invested in have got very, very safe cash flow models. They're mostly on subscription-based models, whether you're buying cybersecurity services, cloud computing services, even certain social media or online gaming services. These are all based on monthly subscription revenue. It's very different to 2000, 2001, when you had these things like pets.com spending $1 million a minute on Super Bowl advertising or other unsustainable types of business operations. So the point for us is the healthier tech firms are very well positioned to ride out the storm, regardless of where the inflation rate really is. I think that the challenge is that the smaller guys who don't have EBITDA earnings or current profitability, they're the ones who we expect their valuations to remain significantly under pressure. Obviously, it does make a difference for all companies if inflation exceeds the cost of living uh, raises in terms of people's wages. And I know here in the UK, it's a big, big issue. Cost of living increases. So it is a tough time. I'm hoping that the two things we're looking out for is one, that the Republicans will probably have a landslide victory against the Democrats, most likely in November, because Biden is quite unpopular with what's going on geopolitically with the Afghanistan pullout, but also more importantly with the cost of living increases and the difficulty with the petrol prices. In the US, incidentally, our increase in petrol prices has been far more dramatic than here in Europe or in the UK. So petrol prices have essentially doubled in America. So there's a lot of negativity. So we think it's a perfect storm for Biden, and he'll probably see something that Wall Street really likes, which is a split government. The Democrats in the White House and the Republicans controlling Congress. That'll probably help boost the markets later in the year, assuming, of course, that the inflation numbers and the prints for inflation come down. So the key thing that we're looking out for, Daniela, is to see inflation drop below 8%, hopefully in the next few months, and then watch out for the political ground to shift in Washington as well.
Yeah, and just to finish off, let's talk about, the immediate future, or the longer term future for your fund, because you were talking there that more than half of the fund is invested in US companies, but still very underweight compared to your other tech benchmarks out there. Do you think that international growth is a key driver for the fund in the future?
Yes, absolutely. Particularly, we have certain sub-themes such as digital entertainment, where I mentioned the Asia Pacific market is amongst the fastest growing in the world, but also electric vehicles. Frankly, America is still way behind in EVs compared to the likes of China and European and even UK adoption. You guys have a lot more in the UK in terms of electric charging stations, whereas in America, where I am in LA, you can't drive your Tesla to Yosemite National Park without getting stuck, or to San Francisco from LA. So it's encouraging that the Biden administration are rolling out charging stations, and announcing close to $1 trillion in spend, but for electric vehicles. But the point really is that with oil above $100 a barrel on a sustained basis, that's going to push a lot more global demand towards EV. So actually, our tech megatrend ETF is a lot broader than the traditional tech sector has actually been limited. They've constrained it some years ago. The global classification system, they threw out Netflix, Facebook, and a whole bunch of other social media companies out of tech. And also, electric vehicles aren't even seen as part of tech. We've tried to have a broader thematic, disruptive definition. So that's why we have these 8 sub-themes, including robotics and AI, and social media and digital entertainment. So at the end of the day, I can't tell you which one of these sub-themes is going to be the best performer. We tend to be most bullish at the moment on cyber and cloud because we don't see those trends dissipating at all. But I'd say watch out for social media as well as electric vehicles, because with what's going on in Ukraine, we see sustainably high oil prices still driving inflation, and that's going to push more and more Americans anyway, I think Europeans as well, towards sustainable energy, and electric vehicles should be a big beneficiary.
Well, thank you very much, Anthony, for joining me on today's episode of IG's Trading the Markets podcast. That was Anthony Ginsberg, manager of the Tech Megatrends ETF, giving us his views into what to expect in the tech sector over the coming months. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.